In 1980, when I was young and the market was still fresh to me, I saw my first short squeeze. That's when a stock or a commodity is being pushed up and up and up. What was being squeezed? Silver, that's what. And who was doing the squeezing? Two Texan old boys named Herbie and Bunky Hunt. How do they squeeze it? Why, they bought 70% of all the silver in the world, both metal and futures, and sat on it. They had just inherited a lot of money from their papa, as well as some oil wells. And why did this cause such a big price shoot-up of silver? It was this. The futures market is buying and selling rights to deliver or take delivery of fixed amount of a commodity at a certain price. By definition, then, for every long position, there's a short one, and vice versa. So if you are long silver future, when the contract expires, you can demand to take delivery of actual physical silver. Who do you demand it from? Why, from the one who is short the same contract. The key is you can insist on physical delivery, and then the pool short has to go to the physical market and buy the silver physically and deliver it to you physically at a certain accepted place. Now, what if the pool sucker short tries to buy physical silver and there simply isn't any to sell because Herbie and Bunky bought most of it and are not selling? Then the old Wall Street adage applies. He who sells what isn't his'n will give it quick or go to prison. So what was the result of the Hunt brothers' play? In 1980, the poor silver shorts got squeezed and had to bid up the price of silver from high single digits to $50 an ounce. So the Hunts made a fortune, no? No, because the authorities of the commodities market intervened. How could the authorities intervene if the Hunts owed physical silver outright and refused to sell it? After all, it was their property to do with what they wanted, no? Well, it would have been if they owned only physical silver. But you see, the Hunts became greedy, and so they also went into the future market themselves with borrowed money and bought more and more futures on margin, which is borrowed money on borrowed money. So then the men, that is the commodity market chiefs, changed the margin rules and told the Hunts to put up more cash or close their positions. All this happened on what became known as Silver Thursday, March 27, 1980, when the Hunts could not meet margin calls due to falling silver prices. Silver plunged from $50 per ounce to under 11, resulting in losses of about $1.7 billion for the two brothers. And that was when $1 billion was real money. The rapid fall was exacerbated by panic selling among the ragtag tag-along investors, many of them golf buddies of the Hunts, who feared further losses, and many of them faced margin calls of their own. The Hunts had to sell their oil wells too, which they got from Papa, and eventually went completely bankrupt. They were fined and were forbidden to play in commodities. In fact, in the bankruptcy trial, Bunky, several times divorced by then, which cost him another fortune, asked for the judge's compassion and famously said that he was down to his last $10 billion. Now, why am I telling you this 45-year-old drama? Because the same thing may be about to be repeated. I'm saying may. Repeated how? Repeated in London when the physical silver market allegedly is in the process of being squeezed. Maybe. And who is going to play the role of Herbie and Bunky Hunt? Why, none other than Blackrock, led by Larry Fink, whose name is almost as melodious as that of Bunky. Blackrock, you see, is the company behind the SLV ETF. It's a tradable stock that's supposed to be backed by silver, physical silver. You buy a share of SLV, and BlackRock must buy silver to back it up. Can you demand delivery of the silver behind your share, like in the futures market? No, not if you are a small owner. But if you own 50,000 shares, you can, which means that rich, wily hedge funds can do it to BlackRock. But what if all such large owners suddenly demand a delivery? BlackRock certainly doesn't own enough of it, so they say. Will it be forced to go to the market and buy? Well, it could try, but there's probably not enough physical silver being traded daily or even weekly to cover all the SLV obligations. In other words, BlackRock here, without any papa or oil wells, may be playing the inadvertent role of Bunky Hunt and his brother. To make it clearer how BlackRock got into it, let's change the analogy to that of a bank. Once we do, we can say that BlackRock has built SLV along a bank structure, where the bank borrows short and lends long. That is, the bank takes in cash deposit, which it then has to return on demand, but it lends the proceeds on 20-year mortgages which lock in the money. Borrowing short and lending long is not a very stable business and can cause a bank run if all depositors want their money back all at once. The bank's bet is that only a small number of the depositors would want their money back at any point, not all together. But what if more depositors want the money back than the bank has in cash on hand? This will cause a bank run. They all want cash while the bank is short cash. This too is a short squeeze of sorts. But because the government has an interest to keep the bank solvent, the government will come to the rescue and print cash to give to the bank's depositors. But please note the difference. This monkey business in banking works in banking, where the government can print money. But Larry Fink's mistake was he may be short actual silver. And last time I looked, no one can print silver. So if all of a sudden many large holders of SLV band together and want a physical silver, among which some canny hedge funds who took a position like Herbie and Bunky did 45 years ago, then silver can shoot up and up and up all over again. How high can it shoot? From the current $30 and change, it can double easily, perhaps even double and a half, to 60 or 70. And then, will the price stay there? Probably not, because then, like the old commodity exchange who changed the margin rules, causing the Hunt's bankruptcy, the British authorities may come to the rescue and change the rules also. This will shaft all the late buyers of silver and cause the price to plunge again to probably close to the current price or close to it. Do I have any support to this wild theory? Only this. Last month, Larry Fink brought all his BlackRock board of directors to meet the British Prime Minister to discuss regulatory reform. Can they be discussing silver? It's possible, but the squeeze problem will not be easily resolved because there are too many parties involved here. But couldn't the British government help? After all, with all the political power that BlackRock has in the US, surely the US Commerce Department would be pushing for it too. Maybe yes, maybe no, because the contract between the buyers of the SLV, the public, and the sellers, that's Larry and BlackRock, is strictly a commercial undertaking backed by British law with 1,000 years of precedents, commercial law, common law. This isn't easily manipulated as changing margin rules in Philadelphia. So what does it all mean for investors and speculators? It means that silver might, just might, repeat what it has done 45 years ago, and I, a lowly sleuth investor, semi-retired, will be able to see the same lovely financial fireworks twice in a lifetime. Practically speaking, though, the doubling of the price in less than a year and then a plunge to original price in another year would be a classic speculative setup ripe for options play. Not that I'm recommending doing anything here. Remember, I'm just painting a scenario and draw some theoretical implication so that you can follow it with sleuthing of your own as an exercise. So for the last time, the above is not a forecast, nor a recommendation, just a reminiscence of a semi-retired sleuth investor who may have forgotten what he ate for breakfast, but somehow remembers very vividly every old market shenanigan of the last 50 years as if it happened yesterday. When you reach my age, you'll see what I mean. That's all for today. Please let me know in the comment below what you think of the above. And if you like it, subscribe and forward to all your subscribers and friends so they're subscribed to. And buy my books, The Sleuth Investor, The Advanced Sleuth Investor. And if you like them, give them a review on Amazon, which I hope will be a good one. I'll see you next time. And in the meantime, thank you very much for watching.